hopefully a couple more. I know that Grace has heard from a couple that weren't able to come today. It is July. But hopefully a couple more will be able to come in, because I think we have a really good program today. I'm excited to hear it myself. But as always, we start off with introducing our breakfast sponsors, and we're very grateful for Founders. They are always very, very supportive of everything that the Chamber does, and me personally. So very thankful for the relationships there and them going above and beyond to be very helpful. So I am going to just turn it over to you guys and let you introduce yourselves, and I know they got a little bit to say. Their business cards are up here, and so if anybody wants to grab one of those before you leave because you need to contact for some reason, then please do so. And again, thank you so much for sponsoring breakfast this morning. Thank you. I'll turn it over to you.
I'm Casey Thornton. I'm the branch manager in the Lawrence location. So if y'all ever need anything, you're welcome to come in Lawrence, and we'll be glad to help you.
I'm Brittany George. I'm the branch manager in Clinton.
Okay, I'm Jared. I do business development for Founders. My territory is basically from Clemson all the way to Union, and my job is to kind of form partnerships with different businesses and founders. We give them the free benefit for all their employees to join our credit union. So we kind of like to have some type of relationship just outside of, just someone walking in the branch. You like to know where they work, where they live and worship and things like that. What comes with membership is pretty simple. It's a free benefit. All it takes is one letter. It'll basically say your business would like to be added into our field of membership. You just list the number of employees you have, how far you are from our closest branch, which will be Lawrence or our Clinton branch. And from there, you could just kind of share our information with your employees. Some businesses, they'll put it in like their onboarding packets or something like that. Or if you're looking to have if you have a bigger staff, you can do lunch and learns. We sponsor breakfasts like this. Just different opportunities for us to show our faces and kind of tell different companies and businesses what we offer as far as products and services. We do checking, savings, no account fees attached to those, and pretty much loans for mortgages, cars, investments, insurance. So we're pretty much a one-stop shop for anything that you need. So my card will be there, and both of our branch managers' cards are there as well. So if you have any questions, just reach out.
Thank you.
Thank you.
Welcome.
Thank you.
Thanks for breakfast.
Thank you.
Thank you.
That's good.
All right, guys, thank you so much again. I'm sorry, this room is the worst setup. You can't get around it without walking all the way around it, but they're connected, so. All right, so now I'm going to introduce our speakers this morning. Our topic today is finance. This is a not very casual, but it is casual, where there's just a Q&A, and they will interact with you guys and ask questions, and I assume you encourage that and welcome that communication. This is our small business empowerment program. I think Grayson explained it to you that it's an 8-month program, and these are our small businesses that have signed up to just to work towards growing their business and sustainability, and so there's different topics each month, and so we're very excited about the finance. At least I'm very excited about that part. That's definitely never been one of my strong points personally, and I feel like a lot of the people in the room, I know Heather's smiling and she's got this, but a lot of people in the room have that really creative mind, and finance might not be the biggest focus, so I really appreciate you giving your time today. So for all of you, this is Gary Bailey and Paul Klein, and I'm going to just turn it over to you guys.
All right. I'll start with Paul. Is going to lead the presentation. Paul leads our firm in the accounting and tax department. So he put this presentation together, and he works with small businesses all the time. And what we always tell small businesses: cash flow, cash flow, cash flow. So every small business has some kind of skill, and that's where you went into small business. You have some kind of skill that, whether it be design or whatever it might be, but most of the time what we find with small businesses is cash flow management is not one of those skills. So that's where we try to come in and help small businesses and just let them know that you can have a very successful business and not manage your accounting and cash flow, and it will fail. And we've seen that a lot of times. And so that's kind of where we come in to try to help and just give some basic understanding of what that means and how you should keep your books. I saw a quote not too long ago that said, accounting is not an expense, it's an investment. And I think that's very true. Either you invest your own time keeping your books in order, or you invest some of your money and pay someone else to keep your books in order. but they need to be in order so you understand what's going on with your business. So with that being said, I'm going to turn it over to Paul, and just like Amanda said, very casual. We hope that if you see any slide or anything, that just interrupt and ask the questions. That's what we're here to help. And so if anything pops up in your mind, even if it's not on that particular slide, if it pops in your mind and you want to ask us, just go ahead and ask us. So we do this a lot, so we're not. It's not going to hurt our feelings to stop and completely go on a different track because something else interests the group. So with that being said, I'm turning to Paul.
Appreciate it. Thank you. The only caveat to that is easy questions you can give to me, hard questions you can give to Gary. So think about that before you ask your question. I guess the first thing I want to start with is the question I get all the time is, can I write it off, right? I get a phone call probably 9 out of 10 times, hey, is this a business expense? Of course, people ask me what I should write off. They don't ask me, what would you do? They won't ever ask me that question. But anyway, so the general rule from the IRS is that if you're a business, you can write off ordinary and necessary business expenses. And then there's not really a definition to tell you, well, what are all those, right? So that means any number of expenses, but the thing that I want to talk to you all about are the things that you can't write off, right? There are probably a number of things that you can't write off when you get into the minutia of tax law, but the two big ones in your average business that maybe you don't think about, one would be payments directly to the owner. Right? So you have a small business and you're paying for all of your office and advertising and supplies and all those sorts of things, but then you take your draws, right? You got to pay yourself. Well, if you've got your bookkeeping structure set up, maybe you've got QuickBooks, whatever you're using, and you put that as a payroll expense or an owner's expense or whatever you want to call it, and then you come to your tax preparer at tax time, we've got to move those out, right? So all of a sudden you're walking in, you're pretty confident, I don't think I'm showing any profit this year. And then your accountant, your CPA is gonna take those expenses off the books. And what's your income gonna do? Your income is gonna go up, right? So there's gonna be a difference between perception probably and then reality when it comes to tax time. And the other thing you can't write off.
Let me add a good example on that, because we see this so much. Sorry, I'll interrupt Paul.
Sorry.
But we have that scenario happen a lot where on the QuickBooks file, as Paul said, there will be a line that says, we're not talking about payroll where you actually do pay yourself like through a W-2. We're talking just you wrote yourself a check out of the business. And we'll see that line item on there that says owner distribution, owner draw, something like that. And as Paul said, we got to pull it back out. But here's what's happened. The owner's taken that money, they've spent that money, and then they come to us with a P&L that says, I didn't make any money, I lost money. And we have to say, no, you didn't. You took $75,000 out of the business. I got to take that out because that's technically what you made in income. And so they haven't thought through that process. They took the money out and spent it, and now it's time to pay the taxes on that $75,000, and they spent the money.
Right.
So something just to kind of, again, another one of those, you have to manage your cash flow and understand how taxes work during the year, not right at the end of the year when you're going to bring your tax return.
That's right.
To get prepared.
That's right.
Sorry.
Then if you got a 20, think if you're paying 20% on the dollar, right?
Yeah.
So multiply that by 20%, and you went from maybe getting a refund to maybe now you owe $5,000 or $6,000, and it's a shock when you're not expecting it going in.
And it's basically just because you were throwing that distribution as an expense, and you got to think about it from the IRS perspective. That wasn't an expense. That was profit that you took out. It wasn't an expense. So profit is taxable.
It felt necessary.
Yeah, that's right. You're
right.
like, I got to pay my house payment and
right.
all these other things.
Right. The other one is the other big one is principal payments on loans. So this happens probably one of the more common occurrences we see. You buy a vehicle, you buy a piece of equipment, and then the next year you start making your payments on those. Maybe it's $500 a month, or maybe you went and bought one of the big trucks over here, and maybe it was like a home mortgage, right? Maybe it was $1,000, $1,200 a month. And again, when it comes to tax time, we've got to take those off the books. So it may look like you didn't do well during the year, but in fact, all of your income, it was going to paying off those principal payments. And so how it works is more than likely, whatever you purchased in the year of purchase, you were able to write it off in taxes, right? So in that year, cash flow is good, right? And then in the subsequent years, one of the things we see, you might hear the word being overly leveraged. That's a term that's common, but at the end of the day, where all of our cash is going to pay off principal payments on loans, and that's profit.
Yeah, that's another issue that you see a lot with small businesses, where they'll come in and they'll say, I want to buy this truck, or I want to buy this piece of equipment, and in year one they spend $100,000, and well, you get to write that entire amount off in year number one. So what happens? You have this huge, and a lot of times people finance it, so they get $100,000 expense and they finance the whole thing. So it didn't actually use any cash flow, maybe just a few payments they made during the year. So like Paul said, they come in that year and they might get a nice refund, or not have a big tax liability that they used to. But then the next year, when they're recording those principal payments, they don't get to deduct that anymore, because you don't get to do it twice. You've already took the cost of that piece of equipment. So next year, their profit number also has to take in consideration. So they're paying tax on the profit, but then that cash flow also has to be used to pay off the principal. So again, that goes back to managing that cash flow. So a lot of times someone didn't think through, when we're doing tax planning, we'll have people come in and they'll say, I just don't want to pay any taxes. I just don't want to pay any taxes. That may or may not be the right strategy. So our strategy has always been, at the end of the day, was the result more money in your bank account or less money in your bank account? And it's not necessarily right now, but look at the strategy. So if someone comes and says, I'm going to buy this piece of equipment for $100,000, we can tell them what the tax savings are right now, and then kind of project what it's going to look like when you're paying those payments in years 2, 3, 4, and 5. So what we typically ask is, what are you going to do with that piece of equipment? Is it going to generate more income? Because some folks they hate paying taxes. Don't get me wrong, I don't like paying taxes either. But if some people don't want to pay taxes so much that they're willing to buy a $100,000 piece of equipment to save 20 cents on the dollar. So they spend $100 to avoid paying $20,000 in taxes, and that $100,000 piece of equipment or truck's just sitting in the parking lot not being used. And sometimes it might be just pay the $20,000 in taxes and keep the $80,000 in your bank to do something in the future. So it's not always how I can get my taxes lower. It's really like, what's the result of having more money in my bank? What's the real strategy? So that's kind of, I know you're gonna talk about that a little bit more, so I probably jumped.
That's good,
But
that's great.
just wanted to point that out.
I think one other thing, we always tell our clients, again, to answer that question, what can I write off? We tell clients, get a business credit card. So this is simple stuff. Get a business credit card, have a business bank account, and whenever you're acting in your name as a business owner, right, swipe your credit card. Makes life easy. That way, you've got business account, you've got a personal account, you're trying to figure out what's what.
Yeah. Don't pay your mortgage out of the business account.
That's right. So,
Yeah.
right, going to the groceries, you're maybe paying your personal mortgage, but outside of that, use a business credit card, and that way you're going to satisfy those retention requirements or substantiation requirements with the IRS. So you got your business card, you're acting as a business owner, hey, you're going out to lunch.
And there's a little benefit. I have a Capital One that pays 2%.
That's right.
I pay everything in our business on Capital
That's
One.
right. And let
I probably get $4,000 or $5,000 a year back,
Yep.
in 2% off of that, just using that card.
And let the credit card company hold the money, right? Let them be liable if something happens.
That's
So,
right. That's right.
you gotta tell them where you're going, right? If you're going
Yeah.
on a trip, tell them you're going somewhere. Don't cancel it. I've had that happen. All right. Who here does their own books? Do you guys use a software, or do you all do it on Excel, pen and paper?
QuickBooks.
Okay.
Quicken.
Quicken.
Yeah.
Okay. Well, I think this next slide will be helpful when talking about those of you who are accustomed to doing your books and just getting some of the basic structure down on your profit and loss statement. The profit statement you're going to look at the most, because we want to know, hey, am I making money? Am I losing money? But then we try to coach our clients on how to read your financial statements. So it's easy to look at a piece of paper and say, oh yeah, I got money in the bank, or to say, oh, whoa, I'm losing money. But the question is always why, right? And so what I want to show you is just a quick, maybe a few tips, a few tricks on your own financial reporting that will help you make those decisions. So you don't have to be an economic genius to look at your financial statements and say, oh yeah, that's the problem. I can fix that.
Yeah.
So that's what I want to do here.
And one good example, as you're coming, you said you'll look at business owners should be looking at this a lot.
Yep.
But we also see this, business owners will look at their bank account, and that will make them, in their mind, think whether or not they're making money. That is not, has no indication of whether you're making money or not on how much money you have in the bank. This is what's gonna, you could have gotten a loan and you're living off the proceeds of that loan right now, and that's why you have money in the bank.
And I think we can make these slides available, right? I mean,
Yeah,
we,
yeah.
so if I know some of you are all taking pictures, we can make it available. So I don't know who has it. I guess someone at the chamber
Yeah,
probably
we can
has
drop,
it.
we'll drop it in the
So
Google
if
Drive.
you just wanna, take it, it's yours. So what I've done here is I've created just a basic profit and loss statement. And what I wanna show you all is just a few of the basic components of what I think your typical profit and loss statement should look like. So obviously the top line, we've got money in, we've got revenue. But this is the section that most small business owners leave out. And that's gonna be your cost of goods sold. So anybody familiar with that terminology? Oh, whoa, I didn't do that. That was good. So who's familiar with that term, cost of goods sold? So what is that, when you think of cost of goods sold, what does that mean?
Materials. that
Materials?
you use Toward the use of
Yeah,
project.
Our
Yeah,
labor.
that's the
Yeah.
key,
Like,
right?
we're a CPA firm, so our materials would be employees, labor costs, yeah.
That's right. So this would be labor, could be materials, could be fuel costs, anything that you can directly tie to the sale of your product, right? And then your other expenses that you'll see here, these are all normal expenses, rent and insurance and office expenses, et cetera. Those are typically more fixed in nature. You might have heard the term overhead, right? So we always like to split up our profit and loss statement in these two sections. So cost of goods sold, and then we want our other expenses off to, I guess, on the bottom. And I'm gonna show you why. So I got some examples here of some businesses, and I just kind of played with these numbers. We wanna be able to know if something is wrong, right? So, of course, this example here, you wouldn't be in business probably, right? If some of these numbers were true.
I mean, you see that sometimes, you know, you can
Sure,
have a successful
sure.
business, and what's happened over the last few years? Inflation. So there's successful businesses who have seen this number greatly increase, but they haven't been able to pass it all through the top yet. So we've seen some businesses who's been successful, and maybe this number in the past was 900,000, and that was showing 100, 200,000 profit.
Yep.
But inflation has caused those purchase prices to go way up, and now they're showing a loss.
That's
But
right.
like Paul said, you can't have too many of those.
That's
or,
right.
you know,
So just as an example, right?
Yeah.
I made up these numbers, so none of our clients. But anyway, if it's organized correctly, it doesn't take, again, a financial guru to look at this and say, you know what? Yeah, there is a problem. I've got all these sales, so I'm working hard, right? I'm making the phone calls, I'm pounding the pavement, as they say. But look, my gross profit can't even sustain my regular overhead, right? So again, the idea is my cost of goods sold is too high. So I got a problem. I either have to figure out a way to lower those per unit costs, right? Or I've got to figure out a way to increase my per unit pricing to my customers, right? Because typically you see the bottom line, you say, man, I'm struggling, so let me just work harder, right? You guys have all heard the term work smart, right? Not hard, or work smarter, not harder.
Yeah.
In this situation, you've got somebody who's gonna be tempted to work harder, but your gross profit is so low, right? What's left after your cost of goods sold is so
And I will
low.
point out, in this scenario, these are fixed costs, this
Yep.
overhead, so these shouldn't increase. So if I know businesses that 20%, that's all manufacturing companies like 20%, that's the max they're gonna make. There's no way for them to get that percentage up. So for them to stay in business, if this is fixed and they can't lower this, what's the next thing? They got this volume then. They're gonna have to get that number to $3.5 million. If 20%, because you're only getting 20% of that number to cover all of this down below. So that's why Paul's saying this is so important to understand every dollar you bring in, how much does it cost you in a variable cost? And that's gonna be your net.
That's right.
And then that's gotta support everything down below. And guess what? Make you a profit, man. You're in business,
That's
make
right.
a profit.
That's right.
Sorry.
And what you just were saying was my next slide here.
Sorry,
And-
I interrupted.
No, it's good, it's good. So in this situation, you've got a business that has a pretty high gross margin. It's about 60%, and we're breaking even in terms of profit. but we know the answer, right? The answer is every dollar that I sell to a customer, to a client, I'm keeping, before fixed cost, I'm keeping 60%. Well,
Great.
go out and get some more business, right?
Yeah.
So you can see these are just some basic observations. If you have your profit and loss statement set up correctly, then you can quickly analyze and see, hey, where are my problem areas and how can I improve my overall bottom line? How can I increase my profit? And so then this final example, you can see that the overhead costs are high,
Yeah.
right?
I wanna reiterate what you said. If you have it set up correctly, you can look at this and see what the problem is with your business. If you don't, then you're kind of going at it blind, like, I don't know, I'm like doing all this work, I'm making money, I just can't seem to make any profit. Why can't I make any profit? If you don't have books set up correctly, you don't know. Until you have this set up correctly, then you can go in. I know if you got this scenario where maybe you have too much. I mean, that would, in this scenario, that would be a very high labor cost to not be $850,000. You're only having to spend $500,000 in labor to generate $2.5 million, and you got $850,000 in overhead. You can't. So my scenario, and I'm looking at a business. If Paul and I are talking to them, we're gonna say, "Wow, what in the world are you spending down here to support getting that revenue? This number's got to be cut." And that's what we would, if we came in and looked at a business, that's exactly what we would point out to them.
That's right.
Yeah.
Okay, the next thing we're going to talk about is cash flow. So who here has heard of a cash flow statement? Is that, okay, wow, somebody in the back, that's great. This is the statement when we talk to our clients about generating, put it this way, when we talk to clients about their real bottom line, as Gary mentioned earlier, we talk about cash, right? So we see situations all the time where clients have taxable profit, so they're gonna pay taxes, right? But their real bottom line in their business is they've actually lost cash. So is that business, just to use generic terms, is that really profitable, right? If you are making money on your profit and loss statement, but your cash balance is decreasing every year.
Anybody know why? You're not collecting the money. You're selling on credit and you're not collecting that money. So you got all this money that's owed to you, but it's not coming in. So you're showing a profit with no cash.
So this is a typical cash flow statement. And so I, again, just pulled this on an Excel file. But in a cash flow statement, we'll look at this for just a second. It's gonna tell us where cash is going, right? How it's being earned, how it's being spent, etc. And so what a cash flow statement does, so when I explain financials to clients, most people are used to the profit and loss statement, right? You've seen that, we just looked at it. Most people are also familiar with the balance sheet, right? So you know that this is how much money I have in the bank, these are my assets on file, and this is what I owe, right? And so when you look at a balance sheet, I tell people it's a snapshot, it's a picture. And so I think about all the different times in the year that we have to take pictures as a family. I've got 4 little kids, and you don't know what happened before the picture, right? You don't know the faces our kids are making, the teeth we're pulling, and finally you get everybody organized. And of course now your phone, you can take like those rapid fire pictures on your cell phone, and then my wife will scroll through them for 30 minutes and she finds the one where, you know, the heavens are opened and all of our children, you know, maybe 3 of the 4, right? Look, and so we're this happy family, and then that goes out on the Easter card and the Christmas card. So a balance sheet is a picture, right? The profit and loss statement is everything that happened, that 10 minutes of buildup, right? It's like a video. It's what's happening in your business over time until we get to that picture, right? So that's kind of how I describe your financials. But then there's this cash flow statement that most people have never heard of. And what the cash flow statement does is it actually reconciles both those statements. There's cash events that happen on your profit and loss statement, and there's cash events that happen on your balance sheet. But we've got to put those together to understand what's really happening in your business. And so your cash flow statement typically has 3 parts. The first part is called your operating section. And basically what we're doing is we're taking your net profit, which is the the line, I guess the net income from your profit and loss statement, and then we're reconciling it because if you are familiar with, say, accrual type accounting, where you charge customers or your clients, but maybe they pay you 30 days later. Well, we've got to do some adjustments, right, to account for that.
You may hear the term working capital. Have you ever heard that? This is the working capital piece on a cash flow statement. This is what I said earlier, when Paul said your P&L may show a profit, but you didn't actually have any cash because it's all sitting on accounts receivable. This is what this is doing. Like in this case, $250,000 was income, but after you paid debts, collected monies, all those different things with working capital, you actually had $335,000. So this is a good example of you actually generated more cash than the P&L actually said you had. And I was going to point out, when I go talk to a business or even nonprofits, I told this to the chamber. I'll go to the cash flow statement and I'll say, this number right here, that to me is the most important number on all the financials, because at the end of the day, all the activity you had, did it generate you positive cash, or did you use? And if that number is ever negative, you're in trouble, because that's saying I did all this work and I have negative money to show for it. I worked a whole year and it cost me money to actually run this business.
That's right.
So that's a very important number.
That's right. And the idea being that your cash from operations produces enough cash to support all the other activities that go on in the business. And the two other primary cash activities are going to be investments, right? So these are going to be, yes.
I didn't interrupt you, sorry. I'm just curious, a lot of us are, well, everybody here's a small business owner. Would you see in your first kind of couple of years though, maybe not as much profit? I mean, is that, you always hear small businesses, you don't make money for a couple of years or whatever. I mean, if this was a year or two and the cash balance wasn't great, would that be a red flag?
So I would look at, if I were you, if I'm not in my first or second year and I'm not making any money, or slow coming in, we'll say, you're spending, you're probably gonna, in that one P&L, that fixed cost number is gonna be high because you've invested in equipment and all this. I would also evaluate, after I've been in business for 12 months, I would evaluate, do I have a market? That would be very important for you to really sit back and evaluate that to yourself. Do I have a market to generate more revenue? And if that answer is no, quit spending money. I mean, you're putting it into a black hole and never getting back. If you say, yeah, I do think I have a market, I can generate more revenue, and I'm just gonna have to sustain these losses for a little while until I can make a profit. But I think every small business owner has to, so to speak, look in the mirror and say, do I really have a sustainable business here? And before you keep dropping more money into that business.
That's right. Yeah, this is not going to be standard of a startup business. Typically, a startup business, the financing activities, you're going to see the owner putting money into the business, right? So there's going to be money in the business.
Or you're going to have loans. You're going to be financing equipment purchases.
That's right. So there's going to be
money. I was
money.
going to point out, I saw that you're advertising, so service business. Yeah. When I started my CPA firm, I tell people this just so they know. I spent $3,000 more than I made. The whole first year, my income was negative $3,000. The entire first year. Now we have a firm of 15 employees. So just to let you know, yes, you can lose money that first year and still have a viable business, but you still need to evaluate that and determine, is this something that, do I have a good business before I keep sinking money into it?
That's right.
Yeah. I thought you were going to talk about spend money on advertising.
That's what I was
That's what I thought you were going to
say.
Sorry, but in the CPA world, word of mouth is probably the biggest advertiser in our profession.
That's probably all of our business.
Yeah.
That's right. That's right. So just like I did with the profit and loss statement, we're going to look at some scenarios of different businesses, and if you're looking at the cash flow statement, okay, well, what's wrong? And Gary's already mentioned some of these, but this is a cash flow statement of a company. You can see that they had net income of $250,000. But the problem is it never came in, right? So all that was being charged, it was being billed out, but it never came in. And so our net cash provided by operations here was only $75,000, even though our profit and loss statement shows that I made $250,000. Now, of course, some of the scenarios I'm using here, this is a little probably blown up a little bigger than what we would normally see, but these sorts of things do happen. And so now I've generated $75,000 in cash from my operations because I can't get my customers to pay. That's my problem, right? and it's gotta support everything else that happens in the business, right? So.
That's a good point, because you could have a really good business and you just stink at collecting the money.
Yeah.
And you gotta collect the money. Or you could have a great service that people wanna buy, and you're gonna have to learn as a business owner, if you don't do this already, you have to follow up
That's right.
regularly on people who, if you pay, I mean, same with us, we're a CPA firm, but we don't demand that people pay in advance, so we also have AR, and every month I have to follow up and send out invoices and things like that, so that's just a necessary, no one likes doing that, by the way. I've never found anyone who loves to go tell somebody, hey, you owe me, you need to pay. You like to, you don't
That's right, that's right.
See, you can have a business where all you did was go collect for people.
That's right.
But, cause nobody likes doing that.
And we do
Yeah.
see this, even small businesses that work with large suppliers. Suppliers now are saying, well, it used to be net 30, but now it's gonna be net 60, deal with it. And we actually had a case where one of our clients was basically forced into early retirement because his primary customer was a large supplier, and I think they went to either net 60 or net 90. And that was his.
You think about that, you're selling a product that you're not gonna collect on, you're not gonna collect on for 90 days, but you're buying that product, and the manufacturer you're buying it from is demanding payment within 30 days.
That's right.
You got a 60-day gap of time that you have to finance all of
That's
that.
right.
And if you're not big enough, it'll, like in this case, it'll do you in.
That's right, that's right.
Can you speak to, the depreciation on that
Oh,
statement?
yeah.
Because as, you know, I'm not versed in every little piece of
Oh, yes.
that. You know, how would I know what to add back
Oh.
in?
Yeah, sorry. So this line up here, depreciation add back. When you think about your standard course of business, that's probably not something you're gonna see or think about until the very end of the year. And so when it comes to tax time and your tax preparer actually calculates the depreciation, that's gonna show up as, it's gonna help you on your profit and loss statement.
That's gonna be the opposite of the owner distribution.
That's right.
Yeah.
But remember, depreciation is not a cash event, right? It's an event that happens on the books, and so it gets added back on your cash flow statement.
It's a piece of equipment or car that
Yeah.
you bought in some future period, but you're still depreciating that. So you get that, in this case, there would have been $75,000 expense on the income statement. That wasn't cash, you didn't write a check for that
Right.
75. So you get that, it was an expense reducing this number, so you get to add it back. So in that scenario, if you looked at that, you would have really done 325,000 cash flow, because that wasn't really a cash item. But you want that item, because that's gonna lower your taxable income
Right.
when it comes to the tax return.
That's right.
Does that make any sense? And that's kind of I know that's kind of a difficult item, but if you're not familiar with depreciation, just overhead, real top level. You buy a piece of equipment for $100,000, and say you can write it off over 5 years, so you're gonna depreciate that $20,000 a year for 5 years. So you bought that piece of equipment in year one, and then you get a $20,000 expense over the next 5 years.
I guess I'm asking, are those tables that you know, based on last year's depreciation, I know what this year's depreciation.
I see what you're saying, yeah.
And if that's a period that's a quarter, or
Right.
you're just dividing last year's and putting it.
Right,
back in?
so, yeah, depreciation rules are hard, and the reason why they're difficult, and I wish I knew all the tables off the top of my head, and I don't. You can ask Gary though, I bet, no. So.
I usually tell small businesses do a straight line, because there's
Yeah.
these things that you may have heard, like bonus depreciation, or makers, or.
That's right.
Or,
What do you
yeah.
mean straight line, like?
Basically what I said,
You
$100,000, I've gotta depreciate this for
In
5
one-
years,
okay.
so I'm gonna divide it by 5, and I know
What-
every year I'm gonna get $20,000.
And what makes it difficult is the fact that on the way the tax laws work, for most of the things that you're gonna be purchasing, so long as it's not a building, right? You're gonna be able to write it off in year one, or at least most of it in the first year. But when you're doing your books, you're thinking about, okay, is this a 5-year life? Is it a 10-year life? So there's often a discrepancy between the bookkeeping and the tax. And so where the cash flow comes into this, like Gary mentioned, is that you get this tax break in the first year from the IRS, right? And so you buy that piece of equipment, and all of a sudden, my income was lowered by $100,000, right? And so maybe you get a refund. Maybe your tax bill, of course, we get the Christmas phone calls. They want to, every business owner wants to give himself a Christmas gift, right? Which means I can sign my name, I can reduce my profit by $100,000. But then what makes all this difficult is that, right, we forget about Christmas. Christmas was fun, we got the write-off, tax time was great, but now I've got to start paying for it. And when I start paying for that piece of equipment over the next 5 years or the next 10 years, I've already taken the write-off with the IRS in the past. I had a good Christmas last year, but this Christmas I owe, right? Because this is all profit.
And I will point out that one of the reasons that you may use, so book and tax depreciation. If you've ever heard that term, book and tax. So as Paul was saying, tax, you want to maximize, typically you want to maximize the write-off immediately to help your cash flow. But on your book side, you may be going to a bank to finance some new building or piece of equipment, and you want your profit and loss to look better in your balance sheet. So you want to use book depreciation. That means you spread it out further so it looks like your income is higher, but your tax return income is going to look lower. I know that sounds very confusing, and but that's kind of the world you live in, where you have this book tax difference, and you might hear that term. But I was also going to point out that tax piece is always changing. Every legislation, every president, they all have different ideas of how they want the tax code to be structured, and it's always changing. So for you small business owners right now, like President Trump put in certain tax policies. Well, those are starting to expire, and a lot of them will fully expire by the end of 26. One of those, what Paul's saying, is what they call bonus depreciation. So in 22, you could have bought a piece of equipment and wrote off 100% of it. Well, this year in 23, you can only write off 80%, and you gotta push the other 20% to another period. Well, in 24, it's down to 60%, and you gotta push 40%. So until eventually the bonus depreciation is gone. Now, the tax code will expire in 26, and they'll either still be, President Biden will still be the president, or there'll be a new president. But whoever's in that office will have to, with Congress, determine what they're gonna extend, what they're gonna let. And so it's amazing, tax code changes basically with every Congress, with every, I mean, everyone has their own idea. Sometimes, in my opinion, those ideas are good for the country. Sometimes they're just to make your base happy. So, and it's political. So you're gonna see a lot of tax changes over the next few years as business owners, of things you could have written off last year, and you come in and like, I thought I could write that off. Well, you know, you could have 2 years ago. You can't do that now.
But it goes back to our point: cash flow.
Exactly.
Cash is king, right?
Yeah.
Making decisions for the betterment of your business and for the maximization of profit is always better than making the decision based on purely tax.
Yeah.
And so what we see, and I'm sure we said this already today, but what we see over and over and over again is especially with business owners that maybe have some sort of business or maybe even a finance background, is they've heard tax, they've maybe talked to their friends, they've watched the Box Business, and they've heard about, oh, I can take this off my taxes. And when business owners think tax first, they always get burned.
Yeah, and
right?
there's no special formula.
Right.
Regardless of what some of these companies, oh, I can save you this, or I can write off, I can get rid of your tax liability.
Yeah.
The IRS wants you to pay, and they will put a lien on your property, and they will take your stuff to pay that taxes, and especially payroll taxes.
That's
I
right.
never miss out on payroll taxes. That is like the biggest no-no. To the point that you can go to jail. You have a fiduciary responsibility to pay those employment taxes, and if you're the one responsible for that and don't do it, even if you didn't own it, if you were an accountant and that was your responsibility and you didn't own the business and you didn't pay them, they could come after you. So just really want to point that out on the payroll taxes. But there's no special formula. You make money, you pay taxes.
Right.
You can write off, as Paul said at the very beginning, what's considered a business expense. Basically, anything that you use to try to generate profit. I didn't say you had to generate, but you're using that expense to try to generate profit. That's an expense. So I know I'm deviating from the cash flow. I just want to point that out a little bit because.
I have another cash flow question. So I mean, you always hear cash is king, and Dave Ramsey's always talking about you can't pay for cash, you know, all those things.
Yeah.
But is there, in your personal life, you're supposed to have 6 months worth of expenses, right? So in
Yeah.
your business, if you have cash, should you be using cash, or is it better sometimes to use credit?
I like, it depends on the situation.
Right.
I know Dave Ramsey, I don't like debt when it's for fun activities. Like, I don't think you should put your vacation on your credit card unless you're paying your credit card off every month.
Right.
Not putting on a credit card that you're gonna pay for in a year and you've been paying interest. Now, that being said, it depends on the situation. Meaning, if you have a ton of cash in the bank right now, and you said, you know what, the interest rates, I'm gonna go buy this piece of equipment, they want 8.5% now. Now might be the time that you said, I got the cash, I'm gonna use it. But you're also, there's this, if y'all hear it, you constantly hear it now, is our economy gonna go into a recession? Is it heading that? So then you get a little nervous, and you say, well, I might rather pay the interest right now, even short term, just to see where the economy is gonna go and keep my cash. And if everything looks good, maybe I'll just pay off that piece of equipment early. So I think it's really individual. Like, if you finance it, what's your purpose? What are you trying to do? Now, you may have to finance it because you need that piece of equipment to generate more revenue. But if you have the cash, I would decide, because you can also get, you can get 5% or so right now in bank accounts, CDs and stuff on that cash as well. So I think that's an individual choice on each business owner. But I would say the rule of thumb is never finance fun. Only finance things that's going to generate, in the business world, that's going to generate additional revenue for you. Don't finance tax savings, in my opinion, unless that tax savings unless that piece of equipment, again, is needed for your business. That's another thing people will do. They'll buy a truck to save on taxes for a truck they didn't need, and then pay interest to the bank, for it. And you're like, say you were in a 17% tax bracket, and now you're paying 6% on the truck because the interest rates are high. You netted a difference of 10% for 1 year, but you're going to keep paying that 6% on the finance of that truck, and the truck's just sitting in your driveway. And you're kind of like, when you put it all together, you're like, I don't think you saved any money. At the end of the day, you cost yourself a lot of money.
That's right.
Yeah.
That's right. And I think we're going to see some of this happen, and this is the next slide. This is just another example of a cash flow statement. But the one thing we see oftentimes is we see clients that make profit, but all the money gets put into loan payments, right? And so again, show up at tax time, I've made taxable income, I owe taxes on that income, but I don't have any money to show for it because I'm literally taking all of my extra profit and putting it back into these loan payments. And I think we will see some of this. If you're a business that maybe in the past has survived because the economy has been great and you've been putting your extra cash into a lot of those loans, if there is a change in the economy, that's where those loan payments catch back up to you. Because yesterday I had enough money coming in to fund myself and to fund these loan payments, but as the
Had a
economy
20% drop, and that 20%
That's right.
cost me.
That's
Big
right.
time.
That's
We've
right.
seen this. Paul's had a lot of conversations with particularly contractors who are very heavy equipment users, where they keep financing it. And finally, we're telling them, but they're not really listening. We have a lot of these conversations where we're telling you, but you're not listening. And we blame ourselves sometimes because we're trying our best to get it for whoever we're talking to, for them to understand. But we've had these moments where the contractors made money, but this now is taking all their excess money. They've financed so much, and they've saved taxes, by the way. They've saved taxes
Right.
over 3, 4, 5 year period, but they've just spent the money.
But that was yesterday.
Yeah, exactly.
That was yesterday.
They forgot
That's
about that.
Yep.
But now they got these debt payments, and it's using up all their cash. They don't have any cash, and they're saying, hold up, I'm having to pay tax on $250,000, but I don't got any money to pay the tax because all the debt payments is taking my money.
Yeah.
And that's a scenario where they've overfinanced too much. Yeah.
And usually if you're buying a piece of equipment nowadays, you're gonna get some sort of amortization schedule, which is gonna tell you how much you're gonna pay over time. So that 4% interest rate on $100,000, it's not 104. You guys already know that, right? And so in many
But it also
cases,
tell you what your cash flow requirement each
That's right.
year
That's
would
right.
be on that.
that's
equipment.
right, that's
Yeah.
right. Skip. All right, cash flow and taxes.
kind of talk a lot about that.
This is
Yeah.
kind of, same, just a variation on the theme, but this is kind of put this into perspective, always remembering you pay tax on your profit, not on the cash that's in your bank, right? And so you're gonna see your profit and loss, we see it all the time. You're gonna see a company that has profit, it's going to be taxable, but when we come in to tax time, client says, I didn't really have a good year. You know, it was just an okay year. I didn't really make any money. Well, why do you say that? Well, you know, my bank account balance is, it's about the same that it was last year. I didn't make any money. Well,
It's funny how many times we've heard that.
you get taxed on your net income, not on the cash that's in the bank. And so this is just a super basic example. So imagine you make $100,000 and imagine the tax rate is a flat 25%.
25,000 taxes.
$25,000,
On that
right?
scenario.
But let's say that before you pay taxes, your pre-tax cash flow, which means the amount of cash I added to the business before I had to pay Uncle Sam, was $30,000. So what's the math on that? How much cash do I have after all this is said and done at the end of the year? Yeah.
Exactly.
So my real bottom line, my true bottom line is I made $5,000.
And here's a scenario where this would have been that, but the owner took too much money. They didn't think about their tax liability in, so they actually took that out and went ahead and put it in their bank account and spent it.
Yeah.
And now they got $25,000 and they don't know what to do because they didn't plan in
Yeah.
advance for that tax liability.
That's right.
Yeah.
Yes.
I have a question. So is there, a difference when you're talking about this, paying yourself and that sort of thing, when you're like, doing business as, like, I know when my personal bank account is the same as my business.
So
I
you're
mean,
just
it's
a
all
sole,
mine.
a
Sole
single member
proprietor.
owner.
Yeah, so that's different in this situation.
Not really. At the end of the day, that it goes back to that P&L statement, that profit and loss, where even though you're getting paid from different companies to do work that's going in your personal account, you still gotta track that revenue and that.
Yeah, I mean, I have both accounts, but I move money back and forth wherever I
Right.
might
That's
need
right.
it or whatever.
So you have a business account, is that?
Yes, I
Okay.
have a checking account that's my business and a checking account that's my personal.
Right.
But basically, they're the same thing, right? Because
Well-
I'm a sole proprietor.
So
Yes and no, meaning you still are gonna be taxed on that profit and loss statement. So even though you move money from the business to the personal, that goes back to what Paul was saying right in the beginning, it's not an expense. So.
So as long as I don't count it as an expense.
Exactly.
Right.
That's right. And we're about to talk about this in a minute, but you know, not every tax structure is the same. There's actually tax disadvantageous structures and there's tax advantageous structures. And as a sole proprietor, which is going to be the most common form of business ownership, especially if it's just you and maybe you've got one other helper, you're probably going to be a sole proprietor. And so your accounting is really important. So maybe if you've got a bigger business, you've got lots of employees, maybe you have a separate business account, and some of it is easier to kind of keep track of.
Or you might have somebody.
Right.
You're probably
But-
the one that's keeping track of it.
But in your case, what the IRS does is all those payments that you bring over into your checking account, in practicality, it treats it as if that's what you're getting paid, as if you were a W-2 employee. All of your profits are like a wage to you, and for any of you who've been an employee or who have
Right,
paid
yeah.
employees, you get the extra Social Security, Medicare taxes attached on top of that. And so in your case, it's not just an income tax. All the money that you're actually generating from your business is actually considered a wage, and you gotta pay 15% on top of your normal taxes.
Under federal.
And so if you don't have your accounting figured out, I mean,
I'm assuming there's a lot of you that are small, single members that are just Schedule C. On your tax return, there's a Schedule C, and that's where if you're familiar with your tax return.
No, somebody does it.
Yeah, so there would be a Schedule C in your case on your tax return that shows your revenues and expenses. And that's what Paul's saying. That's where a lot of the single member LLCs where they're Schedule C, that net income on that Schedule C is subject to federal income tax, and it's subject to state income tax, and it's subject to Social Security and Medicare tax.
Yep.
And that's 15.2%. flat, man, it's 15, cause see, like Paul's saying, if you're a W-2 employee, you know, when you look at your paycheck, you pay 7.65% in what they call FICA tax, Social Security, Medicare,
Yep.
and your employer pays 7.65%. When you're a small business owner, as a Schedule C, you pay the entire 15.2. So you kind of think about that. If
On
your-
the net income.
Yeah, so if your federal tax rate was, we'll keep it simple, was 10%, the state gets to 7% pretty fast. So we'll say that's at 7. So that's 17% plus 15%. So you think about that.
You're already
So-
a third.
Yeah, you already know right now, and that's at a 10%. What if your federal rate's 20%? You might be
Right.
closer to 40%, over 40%, 42% on your taxes.
And not only that, but it usually hits at once too, right? Unless you are paying taxes in
Yeah.
during the course of the year.
Estimates are very important in that scenario, just so you don't have that huge liability at the end of the year. And you will get penalized. I mean, depending on how much taxes,
Right.
the penalty can be, because the IRS wants you to pay
That's right.
quarterly taxes.
And we love small business owners, we love entrepreneurs, we primarily work with entrepreneurs, but we always have to have this discussion, that when you're starting a business, the tax laws are kind of stacked against you, right? You gotta know that up front. It shouldn't stop you from opening a business, right?
I think owning your own business is the greatest thing. I mean, I encourage all of my 3 kids, I want them to be business owners one day. I mean, so, like Paul said, you just gotta know how the taxes work. And then I know you're gonna talk about a couple other scenarios, but we have one scenario where someone works, we'll say for the hospital, or they work in a profession where it's like therapy or something, and they're W-2. And we'll have this conversation. They'll come in and say, hey, my employer wants to switch me to a 1099. What do you think? Well, are they gonna increase your pay? No, they're gonna keep my pay the same. Then don't do it. It's a terrible idea. Don't do it, because you're about to add more taxes. You're gonna lose health insurance, retirement, all of that.
Yep.
So we have to walk through that scenario and say, here's your break even of what, if you're going from a W-2 to a 1099, this is what you need your employer to pay you now to make up for that difference.
That's right.
So anyways, go ahead.
No, that kind of leads into our next discussion. We've already talked about some of it, but again, knowing the difference between an employee and a small business owner. Employees have health insurance provided for them, have their Social Security and Medicare, it's taken out of the paycheck. We don't think about it.
Half of it's paid for.
Half of it is being paid for by the employer. Federal and state taxes are being taken out during the year. Typically, when you get to tax time, you're looking at a break-even scenario. But as a small business owner, you have to provide for your own benefits. You've got to provide for your own retirement. You've got to pay the excess in tax. And if you're not paying them in over the course of the year, all of it is going to land on you at one time. And so that's why we want to have these types of discussions with our clients. One thing we have been doing with clients quite a bit, and maybe some of you are familiar with this, but there's another type of tax structure that probably some of you have already taken advantage of, and it's called an S corporation. Has anybody heard of an S corporation, or is anybody here an S corporation? Yeah. So I'll give just a real quick flyover of an S corporation. But when you incorporate, you get the advantage of, think about kind of drawing a line in the sand, right? So when you're a sole proprietor, as you mentioned, right, it's all together. The IRS counts you, everything is one and the same. And the problem is, all the income you make is taxed at that extra 15%. But when you're an S corporation, there's like a line that's drawn in the sand between you and your business. So you get to be an employee of your business. And as an employee, you get to be treated like an employee. You get the Social Security, Medicare taxes, right? That works as normal. But then any excess profit that you make does not have that extra 15% tax.
Yeah.
And so you can think about probably the average business owner, if you're able to convert to an S corporation, probably $4,000 to $5,000 would be very conservative. It's going to be probably closer to 7 or 8.
You kind of think if you ran a simple scenario where the sole proprietor made $100,000 a year, and that $100,000 under the C corp, the Schedule C, sole proprietor, it's going to be subject to 15%. So that right there, it's going to be $15,200 in FICA tax. Well, imagine converting to an S corp, and you pay yourself $50,000 in a W-2, and you just take $50,000, the other 50 in distribution.
That's right.
Only the W-2 income, the payroll would be subject to that 15%. So you just cut that down to $7,500. You just, in that scenario, you just saved yourself $7,500. Now, couple things to point out on that. And I'll let you know, like Love Bailey, it's an S Corp. I'm an S Corp, our business. I get a W-2, and then I take distributions. The IRS says your pay has to be what you would pay someone else basically to do that same job. So you can't, in that scenario, take $100,000 and say, well, I only pay myself 10 grand. They would say, no, that's not right. So one thing, you gotta make sure you pay yourself a fair wage, and you gotta run it through payroll. So you gotta have payroll, so you might have some extra cost there. You're gonna have a separate tax return prepared, so there may be some cost. So that $7,500 may end up dropping to $6,000, but still, that's a real $6,000 in that scenario. But the other thing to remember is you are paying less in Social Security. Now, I don't think that's a bad thing personally. I think you'd be better off to take that $6,000 that you, in that scenario that you saved, and go stick it in a 401k, and then that money would belong to you. But I just want to point out, you will get less in Social Security when you retire because you're paying less in.
Right.
But you'll still get the Medicare, the Medicare benefits, which in my opinion, as small business owners, really the only thing you should, in my opinion, you should really worry about is having your health care taken care of when you're that age. And you should be putting money on your own in retirement accounts. And if you get Social Security, that's just like a bonus. Don't bank on it.
Right.
So I just want to point those two things out.
And typically what we see with clients, one of the questions we always get is, well, when is the time? When do I switch? When can I become an S Corp? And as you mentioned, there are some hurdles. There's some administrative burden, right? It's going to cost some money, may take some time. And so usually what we see is when a business gets large enough to start, two things happen really at the same time. You get big enough to where you start needing employees, so you have to get a payroll service anyway. Well, that's your first hurdle. You got to run payroll. Well, if you have multiple employees, there's a sign, right? And the other sign is typically the ouch sign, right? Is when the first year you come in and, oh my goodness, I didn't have pay taxes last year. And when it hurts, right? So usually those two things happen at the same time.
And it's like there's a break even to that.
Yep.
And that first scenario, if it costs you an extra $1,500 to have the tax return prepared and to run a separate payroll, well, if I'm paying less than that in FICA because I don't make it, then why convert to the S Corp? You know, so it's really once you pass whatever the cost of that tax return and the payroll is. Once you cross that, then you can decide at what point you want to convert.
Right. And I think the last thing, just to kind of reiterate what you just said, as a small business owner, obviously one of the perk of being a small business owner is freedom, flexibility. You're your own boss. But the downside is that you have to make up for the things that are being provided had you been doing the same thing but working for a big corporation, right? They're providing your retirement, they're providing your health insurance, they're providing half of those FICA taxes, and not to mention the ease of having the taxes that you're going to owe at tax time being withdrawn.
And I would say
during the year,
you have a fixed pay.
That's right.
Every 2 weeks you're getting a paycheck.
That's
I mean,
right.
Everybody who's a small business owner,
that's right.
That's not always a guarantee that you're
That's
getting
right.
that paycheck every 2 weeks.
And so when you become a small business owner, you have to think for those things. You have to think about not just today, but you've got to think about the future. And the future means healthcare, it means retirement. And so we're always encouraging our small business owners to think about a retirement plan for yourself. One of the easiest ones to do is just called a simple IRA. Maybe you've heard of that. Basically, it works or functions in a similar manner to a 401k, but the difference is you don't have to add all that extra compliance, right? And so you can go to your local broker, you can get it set up, and you can start funding a simple IRA pretty quickly. And the other thing to think about is, and this is really the tough one when it comes to small business owners, but where am I going to be in 10 years? And what I mean by that is, what is the value of my business 10 years from now? Can I sell it? Because that's going to be your exit strategy, right? If I'm not able to put back as much in, say, a 401k plan as my peer who's working for a big box corporation, I've got to have something of value to be able to sell, right? That's going to be part of my retirement plan. And especially when you're a service-based small business owner, you've got to think, if I'm the reason why, if I'm the person that makes this whole thing go, what is my business gonna be worth? Does that make sense? And so these are things that you need to start thinking about, not when you're 2 years away from retirement, but when you're 15 and even 20 years away from retirement. And in our case, I recommend, and it's not always viable in every, I guess, business type or business model, but if you can bring somebody in 10 years before you retire, 15 years before you retire, and let that person be the one who buys you out.
It's the easiest way.
It's the easiest and hardest way.
Yeah. I mean, you can obviously see Paul is a lot younger than I am. And Paul, in 26, Paul will become a partner, and another a guy on the audit side that'll become partners at our firm. So for me, that's the easiest way. I bring in partners, and eventually I retire, and they take over and keep
our kids are the same age, so I don't know how I'm gonna go to buy you out. I don't know how
right.
that's gonna work yet.
I had a 40th birthday present. My wife and I are third one. This is my 40th birthday. Yeah. But, I was gonna point out, sometimes when you go through this, it can seem daunting, because you're thinking, as a small business owner, it's hard enough just doing whatever it is that I do, whether it be plants and landscaping, whether it be advertising, whatever it is that you're doing, that's hard enough. And now you're telling me I gotta do all this other stuff to be profitable. Well, yeah, and sometimes that's where the small business owner has to make that decision. Is it worth it? Do I have a business that's worth it? Do I have a business that I can ultimately, and maybe it's not just about making more money, maybe it's the freedom that you like to have as a small business. But at the same time, we do have to pay our bills. We all typically, most of us have mortgages, and we might have car payments, and we gotta pay food bills, and kids are expensive, and all these things. And so at some point you have to say, I do gotta make whatever my budget is, I gotta make at least that much to pay those bills. So sometimes you have to ask yourself, what we were saying earlier, do I have a business that can generate me income to do those things that I want? And if the answer is no, you have to say, well, can I change it? Can I do other things? Or do I just need to go find a job? Now, I love, as I said, I love entrepreneurs. I love when a community has a bunch of small businesses in it, because I think small businesses are great for your community. I mean, I'm not against the big corporations, but if I can, I shop at small businesses, because I feel like that's supporting your local families in that community. So we shop. I know y'all push that all the time, right? Yeah, and I think we all should. I mean, every person in here lives in Lawrence County. When we shop at these businesses, that money stays here and it supports families here versus going off somewhere else. So, so I'm a big advocate for that. And but if you do these things, the other side of it is there is a ceiling when you work for someone. You got a paycheck and it's fixed. And hopefully the next year comes around and you might get a raise and it's fixed. And that's not a bad thing. You know what you can use dependable. But there's also, as a small business owner, the sky's the limit. You can do whatever you can, whatever that business model you have, whatever service or product you're selling, you can take it as far as you want. So that's the benefit. And like my son, he's heading off, the oldest one's heading off, I got one in first grade, one going to college, and one in the middle. And the oldest one's heading off to college, and he's majoring in accounting. So me as a father, I'm pretty excited about that, because he's gonna start interning next summer and intern every summer, and he's gonna come to work for our firm. And so just as a father, I'm pretty excited.
That's what I'm thinking, by the way.
What's that?
That's my exit strategy.
3 or 4 years from now, when my son gets to join our practice and start working with. So that's a benefit that you get as a small business owner, that's not just about money or not about just what you're doing, but now you get some other benefit that you might enjoy.
I think the final word on that, I think what you're trying to communicate is influence, right?
That is true.
That word is so
That is
important
true.
today. And so think about small business owners, you all in this room collectively, you get to influence people in a way that others can't, right? Yeah. And so when I think about the health of our community, I think about that word influence. Yeah. I want to employ people that get to work under our leadership, our values, right? Not necessarily those of your big box corporation.
Yeah.
Wherever those mandates or rules or ethics are being handed down from, you as a small business owner get to decide that for your firm. And so for us as a Christian firm, we really deeply care about that. We get to, we think about, how do you influence people in today's world? Well, you can be an entrepreneur. You can make a product that serves another person, right? Or you can own a business that employs certain people, and you get to treat those people in a certain way, right? That corresponds to your value system, right? So you have the opportunity to be the biggest influencers in your community without even thinking about it. And I think when we learn economics in school, we learn dollars and cents, we learn supply and demand. All those things are important, but we don't learn about influence. And an economy is totally built upon influence. Somebody is delivering a service that someone else needs, right? I'm actually doing something
all those
for
interactions
you, right? And you know what? In turn, God takes care of it, right? And so we need to think, and so I think our final pitch would be, we want to leave that to you all, is we love small business owners, and we love the economics of small business, and we see you all as the primary influencers in our community, and we want you all to think of yourselves in that way. You touch more people than you realize, and that's the value of a small business.
I want to add to that.
You all touch those folks.
Before I joined George, and George has been loved. He's been retired many years now. But before I partnered with George, I was a CFO of a big manufacturing company, and we had offices in Ningbo, China, and in Hong Kong, and in Union. And it was right when 2008 happened, and if y'all remember the housing market, well, 50% of the business was home decor. Destroyed it, it was nothing. And they had a big management team, of which I was a part of, being the CFO, and we made a lot of money. We did. And the owners were in another state, they were private equity, and they said, we're gonna come in and we're gonna slash all labor 10%. Across the board, everybody's getting slashed 10%. We went to them and said, hey, we got some folks on the floor that are making $8.50. They can't take a 10% cut. Why don't you cut the upper management more and save those, because they're going down to $7.75. So they can't make. Wouldn't do it. They said, nope, we're cutting it. We want everybody to know that we're in this together. And that moment, it kind of is what Paul said. In that moment, I said, I don't like it. I'm starting my own business so I can treat my employees the way I want to treat them and make decisions that's good and that's honoring Christ. And that's why I'm going to start my own practice. So it's funny, they didn't want me to leave, and they don't realize it was their decision on why I bailed on the business and joined up with George. So just kind of goes with Paul said. You have all this influence, and now we have 15 people at our office, and we get to treat them in a God-honoring way, and it's a great environment, and not overwork them, not underpay them, and we just really are blessed with a good group there. So. I guess any questions from all that? That's kind of a lot of information on that, yeah.
Well, y'all like set the path for our next meeting, which is health and development. Like, what is your why, and taking care of yourself, and why are you doing what you do? So that's our next session. So your closing was perfect for that. It is a lot. Like I feel like I have so many questions. But so much to unpack with everything that you all shared as well. Does anyone have any, and it could be super small, any questions at all while we have their attention and amazing brains?
How do you value a business for sale? Like when you mentioned, you have to really look at it 10 years from now, and how do you place
I'm gonna feed off something you said.
I bet you can, based on what we've been saying, I bet you can guess the answer. I'll let Gary.
Well, I was going to say the first part was going to be what Paul said there at the end. Is the business all you? Meaning, how do you sell something if you're not there? How do you sell your business? Like if everybody just says, "I only come to Gary," and so I always tell everybody, "I'm the dumb one. You should come to Paul." Paul's the one that's going to be taking over. But really, the first part would be, what do you have to sell? Right. So the first value would be what you have to sell, and if it's all you, and you're not there, is there anything to sell? Right. So having employees and training those employees to take your model on a service-oriented business. Now, if you have a store, for instance, maybe you have a store and your service. It's a combination, pointing there. Right. So the first part is, can you separate yourself from the business and sell it? That's the first part. If that's a yes, then it's typically gonna be how much cash flow goes to the owner. It's gonna be cash flow to the owner. If the cash flow is $25,000, they're gonna say, you generate, it's not gonna be revenue. They're gonna say, you generated $1 million in revenue and all you took was $25,000. They're like, dude, I don't even want it. I wouldn't take this for free because you had to work so hard for $1 million in revenue and all you got was $25,000.
That's right.
So that's gonna be, the next biggest piece will be, what's the cash flow to owner? And typically, depending on what kind of business it is, it could be anywhere from 2 to 6 or 7 multiple.
That's
And,
right.
and the other third part, like I'm gonna talk about CPA firms. CPA firms are more valuable when the processes are automated. When you can take our firm and someone in Atlanta can buy it and keep operating our firm with no management coming up here, the folks that are here, that makes it a lot more valuable. If they came in and they're like, man, y'all do everything on paper, they're gonna be like, I'm not even buying this thing. It's not worth anything to me.
Right.
If it's automated and you can do work from home, you can work and you can, like we service clients all over South Carolina and Georgia. That's our base, all over South Carolina and Georgia. And we're completely cloud. We don't have a file cabinet in our entire office for a CPA firm. And so that makes us a lot more valuable because someone can buy that and just easily tuck it into their CPA firm if they wanted to. So, anyway, add to that.
Yeah, I think putting these two things together, right, is being able to have good cash flow, right, but also the timing of all this is being able to bring in somebody who can buy you out. Because if not, you run into the situation that Gary mentioned, is the business is me. Well, I'm not gonna buy your business because maybe I have a financial background, but I don't know how to do what you do. So I can't take what you have and make money off of it. Does that make sense? Now, if you're more of a product-based business, and maybe there's some things you're selling, like maybe you can sell like inventory, maybe you have a different discussion, but for most folks who are small business owners, you're primarily gonna be regarded in the service-based industry, and you're the one who has the skills. So you need to train someone and develop that person, give that person that skill set. So then when it comes time to sell, the idea would be that last 5 years before you think about selling are your best years, your highest cash flow. You've trained someone to take over, and so then when that person buys you out, that person can buy out future cash flow. Does that make sense? So you can leave, I can enter into your space, and hopefully the business won't suffer such a setback.
You self-financed it. Like
That's right.
they would use some of those profits on those next few years to send you payments for
That's
retiring. That's probably for small businesses like this group, that is probably gonna be by far your best model.
Yeah.
Because it's very difficult. There's a lot of folks who want to buy businesses, but typically they're gonna look at how much you're generating, what's your potential growth. But the best way is what Paul said, is bring someone in, work with them, and let them eventually take over. And I will say this is kind of a tough thing to say because you want to look out for your folks, but you're the owner. You obviously should be making the majority of the profits. You've taken all the risk, you've spent all that time building up that business. So when you bring somebody in, you don't bring somebody in and you pay them exactly what you're getting paid. That you've said you've devalued yourself and all that you've done to get to that point. And two, why are they gonna buy your business? You just told them you're making exactly what I'm making. Why would they say, I want to buy your business now? There's no benefit to them to buy it. Because all they're gonna do is keep making the same that they're making, and the profits that you were making, they're going to be, and they're probably gonna have to hire someone to replace the owner who just retired to continue to get the work done. So just think about that too. Like, don't devalue yourself when you do bring in employees, because you've spent all these years, you've put all the risk, you've invested money that you haven't gotten back, or setting an equity in the business. So don't devalue yourself if you do end up going with that model and bringing someone in to take over.
Because the alternative is working another 10 years and then shutting down the doors. Right?
Which hurts
and then
the buyer.
And then what do we, small towns, what do we see? There goes that business, right? That's the alternative, is to work 10 more years and shut the doors.
We see that a lot. We'll talk to small business and we'll say, well, what's your plan for the future? It's gonna work 10 more years and shut it down. And we're like, you got a good business here. Why would you not want to sell it and get some additional retirement funds here at the end? That doesn't, some people don't care. They're like, I've had a good run, I'm good to go. And they're like, well, it's not just that you get a retirement, but you obviously have a business that the community enjoys and is successful.
That's right.
And now it's gonna shut down, so the community will also miss this service that you're providing. So, and the opportunity for maybe some younger person to come in and take over and keep that community going with small businesses. So,
That's right.
Yeah.
I'm in the early stages of that 10 to 15 year prep. And so what, do you have a general formula or rule of thumb? You know, we keep talking about buying out a business. How do you know how much to offer for that business? Is it based off of revenue forever, how long? You know, and I know there's a lot of factors, but just a general, to even know a ballpark.
I would say if you wanted to use just a rough ballpark,
Right.
take how much you get paid as a business owner, which what we call cash flow to owner, multiply it by 3. That's a good ballpark. If you make $150,000 a year, we're saying your business is worth $450,000.
Thank you.
Yeah.
Okay.
That's right.
See, I'm different, like, because, and I'm past that stage. I've been thinking about this for a couple of years, but I feel like that's the idea, but that makes me really nervous to pay somebody like, you know, more than like $10 an hour. But, I feel like I need to do that because I'm not in there.
Yeah.
For the past, 15, 16 years, I'm not in there. I don't work an hour. I mean, I'm in there, but I'm not.
Yeah.
So if somebody came in and wanted to work 40 hours a week, then one, they could pay themselves a lot more, and the potential. So that's where I'm kind of up in the air, is like, what is the potential of the business if you actually had a person who was, like, if I was in there to work.
So
but with
you're
4
absent,
children,
yeah.
I can't.
So that's a good question, and I'm gonna tell you this. I don't know if you know, my wife and I we renovated a big building, old Palmetto building on the square, and the Artist Coop is moving out at the end of this year. And I bought a Groucho's franchise, and I don't know if you're familiar with Groucho's, a sound shop. So I'm putting a Groucho's franchise in there. I'm not gonna run it at all. I'm gonna be a complete absentee owner. But, so I'm gonna pay someone, so what I'm doing, so in that scenario, I'm only getting whatever profits are left. In that scenario, I'm paying someone a fixed salary, and I'm actually gonna give them a percentage of the profits to grow it. But even with that scenario, I'm probably going to, unlike the multiple of 3 on that one day, my hope is, I just want to Groucho's Sound Shop and someone to rent some space in our building. I don't really want to own the Groucho's, but I had to buy the franchise to get it in there.
But that's your selling point. You're selling a franchise.
Exactly.
You're not selling a small
That's
business.
right.
Exactly.
You're selling a piece of a big business.
But it's sort of the same thing. You're selling, if that franchise doesn't sell enough sandwiches and alarms, it ain't got any value. So it's still got to make a profit. So in this scenario, I brought this young man in. He's going to run the place, and my goal is to eventually sell him that Groucho's is what I mean, obviously I'm not going to sell him the building. He's just going to own the business, and he'll keep paying rent. But in that scenario, it's kind of what you're saying. I'm not going to be involved at all. I'm not going to draw a salary. I'm not going to do anything. But I still will know in that scenario, if he buys it, he's going to run it. So that's going to be part of the cash flow to the owner, plus my profit. So we'll just say he made $60,000 and I made $40,000 more in profit. I can use that scenario as what I would be taking to say, technically the cash flow to owner for somebody running that business is $100,000. So maybe I'm going to sell it for $300,000 in that scenario. So that's kind of what I would do in that.
You've got to be able to think about an employee, and especially a key employee that you're thinking about, right? You're cloning yourself. That's the goal.
Yeah.
You're one person. You can only do so much. And so I think it's important to know on the front end, how much does an employee cost? Anytime you're thinking about whether you're bringing on an employee just to grow your business, or you're thinking longer term, bringing on a key employee that may one day buy out my business, the first hurdle is always, what does that employee cost, right?
And so cash flow.
That's right. So cash flow. But that employee is going to make a salary. So that's easy. Yeah, he's going to make $10 an hour and multiply it by whatever. But you factor in your portion of taxes. Maybe there's some other cost. And so at a real baseline, I always tell clients, if you're like you're having this meeting over lunch and you're talking and you're like, well, maybe we should hire an employee, maybe we shouldn't.
It's the
So,
same with
so if
equipment.
if you have a napkin and you're just, kind of scratching some math down, an employee, before any overhead cost sharing, or maybe before even health insurance, stuff like that, you're at about 1.1. So for every dollar that goes out, right, in gross pay, multiply that by 110%. That's baseline. That's before we
Yeah.
consider his other costs. And so probably an employee, especially a key employee, you might be looking at 1.25 to 1.3 as
Yeah.
if I'm paying you $10, it's going to really cost me
$13.
$13. Does that make sense? So know that math. If it's a lower level employee, probably closer to 1.1 plus all the equipment that he
Well,
brings.
I was gonna add, while you're saying that is, it's not just what it's gonna cost you, but what are they gonna bring in?
And that's the second
So,
part.
yeah, so when you bring in that new employee, and you're gonna say, okay, I'm gonna pay them 40 hours. My goal is
Yep.
to get them to buy me out one day. But in that meantime, how much revenue are they gonna at least pay? And it's not, and that's the minimum, they at least pay. The hope would be, I got this person and their goal is my goal is for them to buy me out. So you might wanna have those conversations. This is the plan. So they start understanding, hey, how do we make profit? How do we grow the revenue?
That's right.
And in the meantime, basically, this employee's gonna buy you out. He's gonna make you more profitable to the point that when you sell, they generated you
That's
more
right.
profit. But yeah, if your business, if you look over that scenario and you say, if I bring in somebody who's gonna cost me $1,000 a week, whatever the number might be, there's no way I'm gonna generate enough revenue to cover that person. That's when you go back to, what do I have as far as a viable business? And in that scenario, you may not have a business that's strong enough to bring in someone to take over. You may just have to find someone to buy it, but when you find someone to buy it, I can guarantee you, you're gonna get less for it. Because they're gonna look at your cash flow to owner, they're gonna see what's going on in there, and they're gonna come in and they're gonna say, okay, maybe I'll give you your annual. Maybe your cash flow to owner is $50,000, and they're saying, I'll give you $50,000, and maybe you have some equipment, and I'll buy the equipment at whatever the fair value is, and that's what your buyout. You're typically gonna, unless you just have a very successful business that'll get bought out. But if you have a business where you feel like you can't bring in that person because it can't generate enough revenue, but that's telling me you may have a business that's gonna be more difficult to sell, and your multiple is gonna be lower when you do go to sell it.
That's right.
Yeah.
If someone new starting out, do you suggest them do an S corporation or an LLC? It's like my son.
It all depends.
LLC. I would say,
Yeah.
that's
The
what we
easiest
said
thing to do.
earlier, until you get to a sort of a break even, and that break even would be, what would he pay himself? What would it cost to file the S corp? What would it cost to do the payroll? And until he gets to a certain number, it doesn't make financial
That's right.
sense.
It's
Yeah.
it's easy to go to state
Oh, yeah.
to.
Yeah.
That's
Yeah,
what all
some
ours
do
are,
LLC.
LLCs.
And that's the best part about our state. I mean, you can leave here and go open up a business, immediately. You can have it operating later today. I mean, that's a great thing.
Yeah.
And then when it's successful, then it's time to think about some tax strategies and how to manage that business.
It'd be a trend though, right? You should see in 3 or 4 years, his revenue is increasing. You should see that trend.
Yeah.
Profit is gonna go up. He's gonna feel like, gosh, I can't do all this on my own, right? That's, if you
I'm
start
paying too much in
having,
tax.
if you start having those conversations with yourself, that's an indicator. One thing to remember about the S corp is you can't do it retroactively. We run into that all the time. So usually people come in and they get hit with taxes, and I say, well, you can be an S corp. Oh, it's so great. But
Can't go back and do that.
Can't go backwards.
Right.
You have to do it at the beginning of the year for the coming year. So it's something that, if you're thinking about that, if you're thinking S corp, you should be thinking, I'm gonna have this successful business. And then you should be thinking, okay, I need to make this change before the taxes catch up to me. If that makes sense. See, it's forward planning versus retroactive.
When you're talking about the buyout option, would you encourage, so you bring someone in that's gonna buy your company, and so to give that person a buy-in, you explain what the course of action is, 5-10 years, this is where our profitability should be, and at the end of this time frame, I'm going to sell you this company at this dollar amount. Would you encourage that in a contract basis?
Okay, I'm the only owner of Love Bailey, so I'll give you some how personally we're doing it. So, and a lot of CPA firms do it this way, and a lot of businesses do it this way. So typically, when partners come in, you have a business. You know, it's doing this much revenue and it's generating this much profit. And obviously, your employees aren't going to see your finances. But when somebody's coming in, they're obviously going to start seeing everything. So in our scenario, there's a smaller buy-in. So the new partners will buy into this existing business that's already set up, and we'll have an operating agreement that says, here's how we pay out, this is how we pay bonuses, and most importantly, when somebody retires, this is how they get paid out. Because now I will have a business that has 3 owners, and probably by the time I retire, I'm 47, I plan to work till I'm 70, so by the time I retire, I got a young kid.
I do too, but I'm not working till 70.
Oh, I got an expensive wife too. But anyway. I'm just messing.
This is being recorded.
We were high school sweethearts, so we've been married 24 years in August. So, so the buy-in, and they'll see that. There'll be an agreement in place that says, here's how we buy out, whether it be, sometimes it might be like what Paul said, you might take that your average salary and bonus over the last 5 years and say, whatever that average is, typically the CPA firm, it would be whatever your average pay was, your buyout is 3 times that at the end. And that's and the firm just keeps going. You know, and like I said, by the time I retire, we may have 5 or 6 partners. And the best part in that scenario is the partner only has to come up with a small amount on the front side to buy in. Because I feel like if you're going to have somebody buy in and you're going to give them some ownership in the beginning, they need to have some skin in the game. Again, you've spent all this time and effort, money to grow that business. They need to have something in it. But the best part in that scenario is all they have to do is come up with that initial buy-in, which should be the smaller piece. And then when you retire, the profits you would generate, in my case, the profits I was generating, stays in the business, and they use a portion of those to pay me out over the next, say, 5 years. So if my buyout was $1 million, let's say, they'd pay me a fifth of that, $200,000 a year for the next 5 years. But say I was generating $500,000 in profits, they get to keep all that, and they're going to pay $200,000 out. And so it's a really good scenario for when you have a profitable business where they just have a little buy-in, but then when you retire, they don't have to go get debt. Now they're going to have a little less profit, but then they get to keep operating the business. That's the scenario that most CPA firms use. And I think it's a good scenario to use. That way it just helps you get some money on the front end, and then it helps the owners when you retire it's an easy buyout process.
I would say, just to add to that, something you mentioned, and maybe I was picking this up on your question, but financial disclosure, I don't know if that was part of or built into your question, that's what it sounded like.
Yeah.
So I'm working with, actually when I go back to the office, the first thing I'm gonna do, I've been working for the last month with a client, not anywhere local, but in our state, and they're having a big contract dispute because we have a key employee who I think has seen more than perhaps he or she should have seen. And now that individual wants more of the pie, right? There's a demand being put upon the owner, and we haven't. There's been some initial talks about buy-in, maybe 3, 4, 5 years down the road.
So they're just an employee right now.
Just an employee, but now all of a sudden, I've seen your finances. It's not fair that you make that much money. Give me more.
The funny thing is, they're demanding so much that
that's right.
The owner of this business is actually going to lose money by paying them that much.
That's right.
Yeah.
That's right. So 5 years from
so
5 years from now, there's going to be, as we've talked about, there's going to be no incentive to buy in. So we're pushing back, and they're calling me, and I'm running numbers, and I'm pushing back. You got to lower.
And this is not bragging, but we told them a year ago, and they wouldn't listen to us.
Right.
And now they're back to us again, and we're telling them again, and they're still not listening to us.
It's
to the point where I'm like, we're firing you because you're not listening to us. We're telling you what to do.
The goal is you're bringing along someone, and I know that may take a few years. And so in our case, Gary gradually over time has been sharing a little more. And of course, in our business, I mean, I do numbers all day. I can probably, in my head, get pretty close. But the idea is he's bringing me on. But if you're doing that, I think that the temptation is I found somebody that I like, and this person I want to buy me out in a few years, so let's just give over everything now. But no, you've worked the last 20 years to build up your practice, right? To get to that certain income level, and that person wants that that person needs to buy in. He doesn't just get to share it.
It's really
There's
devaluing
no
yourself
free,
again.
yeah, there's
Don't
no,
devalue your business and what you've done.
there's no
to
free
build it.
riding, right? And so you want the profit, you gotta buy it.
Yeah.
Yes.
Does that make sense?
Watch Suits, they charge $500,000 buy-in on that show.
Well, I will say this, I'll answer your question. The buy-in, we have a level of skill in our country that's retiring. And we don't have a level of skill at we have skilled people, just not as many that is retiring.
Yep.
And that buy-in and what you can sell, getting someone in your business, I think is becoming more important because I think there's gonna be more businesses for sale because people are retiring
That's right.
than buyers.
That's right.
Yes, ma'am.
What is just a rough overall formula to determine a buy-in cost?
Some people will say 10% of revenue. I mean, it depends on what you buy in, like a percentage of revenue. Sometimes people say it. So for instance, you have a $2 million business and people are gonna buy in, and the buy-in is $250,000. And now they own 10% of that $2 million business. That means they're entitled to 10% of the profits. And then in our scenario, the way it would happen is that's the buy-in, but then the growth of that business is equally shared from that point on.
Right.
Because all of these partners are growing this business from
That's
that,
right.
from that point on.
And the idea there is that when we buy in, Gary still maintains control, right?
Yeah.
And so again, we've been mentioning, it should be a process.
Mhm.
And so if someone is an eligible candidate and you wanna sell 10% of your business or 15% of your business, you still maintain control, right? And that is key because again, this is a process. And so the other side of that would be finding something, okay, I'm eager, right? I've heard Paul and Gary tell me, this is what you need to do. So I'm eager, so I'm gonna go sell half my business today. Well, maybe you find out 2 years later, this is a business marriage, right? So you find out 2 years later, this isn't working. Now what do you do? But so yeah, I think that kind of gets to what you're asking.
And I
is
think
we
part of
wanna-
that, when you buy in, is you need to have an operating agreement.
Yep.
And you also need to have some type of evaluation of each of the owners. So you put, this is A, B, C, D, this is what we expect out of all the owners. And then you evaluate yourselves each year to make sure you're following those expectations. Because the worst thing you do is you bring in an owner, and you sell them 10%, and they're so bad that the business actually went the other direction.
Should there be some disillusionment clause?
I agree. Yes, they should always be in that operating agreement. There should be here's what I'm gonna do when I retire. Here's what can happen if it's just not working out and we're gonna break apart. Sometimes the other partners in the CPA firm may say, this guy stinks. We gotta get him out of here. He was good at this level, but he's not good at this level. And sometimes that happens. You know, there's an old saying that says, sometimes everyone's at the level they're least qualified for. You were so qualified to keep getting promoted up, and then you finally got promoted, and you're at a level that you're not qualified for.
Right.
And that could be the case where this person was a great employee, but when they got the pressure of understanding cash flow and payroll and all these things and having to deal with the conversations of employees, they're not good at that anymore. And that may be the case. So you should always have some kind of agreement that says, if we buy back out, or if you have to leave, exit the firm or the business, this is what we would do. And I don't think it might not necessarily be what you paid in. Meaning if you bought in and the business is struggling and has actually declined, you make the agreement, the write-up in the beginning. You need to have all this in writing and agreed upon and signed before you enter into buy-in. Because it might be like, look, we were a $2 million business, now we're $1.5 million. So your 10% is now $150,000, and that's what I'm going to give you back. Right. So all of that needs to be upfront, discussed. And with anyone that wants to buy, that you're in agreement. When Paul and Will come to our firm, we're going to have an operating agreement, and it's not me demanding what they do. It's all three of us. We're, like Paul said, we're a business marriage now. So we're all going to be in agreement that this is how we're going to operate going forward. And that's tough as a single owner, because you get to do it however you want to do it right now. And now you're going to bring someone else in, and you might still be controlling it, but you have partners here. You have other owners that you need to be held accountable to, and that gets tough when you were just doing whatever you wanted to do.
That's why you need to date your potential partners first before you marry them.
So, And that's one thing we did. Paul's been with us 8 years, so when he becomes a partner, he would have been with us 10 years. I mean, I know Paul. I know his family. I know everything about Paul. I know the good things and the irritating things. And he knows the good things, the irritating things about me. And I've got a lot of them. But we know each other. We trust each other. Yeah. I do a lot. I'm older, so I get set in my ways. So, but that's the good things. I know everything about Paul, and he knows everything about me, and the same with Will. He will have been there, I think, maybe 8 years by the time he becomes a partner. So it's good to know those things. It's good to get somebody. It's really good to get somebody in as an employee first before you bring them in straight in as a partial owner.
I agree.
If you can do that, you may be at a point in your business or life of your business or wanting to retire that you just need to bring somebody in and get moving in that direction. So that's a lot of talking.
A lot of really good stuff.
Thank you.
Thank you very much.
Yes, yes. All right, anyone else have any other questions?
I do. Sorry. Basic question, how do I get funding for a startup business?
He's the guy that answers that.
Yeah, funding's really tough. It's going to be dependent on where you want it. I mean, obviously, if you go to the bank, there's going to be certain requirements because the bank's not. I mean, I'm not in banking, but I think there's might be a bank there too. Sort of finance, but you're going to have some kind of collateral if you're going to the bank to get financing because the bank's going to want to know that they can get repaid and they have no knowledge of how the business is going to do. So typically, what I see with a small business owner, which is the risk, what do they put up? Their biggest asset? Their house. They use that as collateral. They use the equity on their house. And so that makes you very nervous. You're like, man, if this business fails, I got this loan attached to my house. Now, you typically don't get, there may be some small credits. Typically, you don't find any funding to operate a for-profit business from the government. You typically don't find any of that. You may find some grants if you bought a building, like facade grants, but you typically don't find any funding to help you with an operation of a for-profit business. Obviously, if you want to start a nonprofit, you are helping youth or with different things like that. We do a lot of nonprofit audits. There's funding there, but for a for-profit, it's usually on you. So you either go to the bank, which is typically going to be your better interest rates, or you go to a private equity group, which is typically going to be a higher interest rate, but you might have more flexibility, but they may also want some ownership in that business. But you're definitely going to need to have a business plan and some projections of what you think that business, and you got to support those projections somehow. You can't just come up with, I'm going to do $400,000 first year. Well, where are you going to get that $400,000? I mean, you're like, I don't know what the business is, but I'm going to service this many people at this average rate, and here's what the market shows, and I've done this study, and this market's underserved with this particular service or this particular product. The bank's going to need something to feel comfortable, and they're still probably going to require some collateral of some sort.
I think one of the reasons why a lot of small businesses are started as kind of I guess they call them side hustles. You hear that term a lot.
It's one of the best ways.
Yes, because you already have funding, right? You're working for somebody. So, it's not too often that you walk out of college and you don't have a dime to your name, and then you say, well, I'm starting a business. Let me go get some money from somebody, right? So that's really, I think, one of the best ways to do it. And just another thing to add to that is the first couple of years when you're starting a business, that cash flow and that tax planning, the first couple of years of your business are vital, make or break, to see you into long-term success. Because what typically happens is that the first couple of years, particularly if you're not, you've maybe gotten some financing, perhaps you're running a loss the first couple of years, maybe even purchased some materials or equipment that we can write off, and maybe you haven't paid the cash out yet. You can see that the very beginning, we see this happen where the first year I thought I was going to have to pay the IRS. Oh, I got a big refund, right? The second year, I thought I was going to have to pay the IRS. I'm so thankful I broke even, right? Well, it's that third year or the fourth year where the taxes begin because of timing with debt and with how they're written off on your tax return. It's not just this nice straight line or curve that you can follow. Okay, well, if I got a refund of $5,000, last year, and maybe then this year maybe I broke even, and maybe next year I'll just owe a couple $1,000s. Usually the swing happens between that maybe third year, maybe fourth year, where the beginning of your business, you've been throwing a lot of money at it, you've gotten a lot of tax breaks, you've gotten to breathe easy on tax day, right? But then year 3, year 4, those things start becoming due. You're making maybe a little bit of profit, and now you've got a big tax bill to deal with. And so I wish that you could easily project what your taxes were gonna be just in a nice little straight line, but often what we see is a big swing.
It's
So
hard.
you're getting a
You know,
lot of
for
help.
new business.
You're
you
getting a
just
lot of
don't
help
know.
in the beginning.
Yeah.
And so that cash flow planning the first 3 or 4 years
Yeah.
is so crucial.
But that's really a good point too, because you can invest this money, hopefully you're making some money, but you're writing off all this depreciation. So if you can, when you start your own business, if you can live on basically the bare minimum. You know, you mentioned Dave Ramsey, someone mentioned Dave Ramsey. Yeah, beans and rice and beans. If you can live off that rice and beans for the first couple of years and put all that cash flow away, if you have a business that's gonna be successful, it will really help you.
That's right.
And that side hustle we see that a lot. So when I joined George, that company that I was a manufacturing CFO for, I actually stayed their CFO part-time for 10 more years. So when I made no money my first year as a partner with George, I had this side job to help me fund my personal expenses. So because who in here can just say, I'm gonna make no money for the whole next year? I mean, I'm dependent on a paycheck, I'm gonna stop that, and next year I'm gonna make no money and still survive. You know, that's pretty tough to do.
That's right.
So, yeah.